Asset management ratios. These ratios measure the company's efficiency in using its assets. So they are called also asset utilization ratios. More specifically, how efficiently a firm uses its assets to generate sales is the aim of using these ratios. The first ratio in the asset management ratios that we want to discuss is inventory turnover. And then using inventory turnover, we will compute days sales in inventory. The formula for inventory turnover is cost of goods sold divided by inventory. Cost of goods sold can be found in income statement, and inventory can be found in current assets of the balance sheet. So for this company, 1,344 divided by inventory, $422 will give you 3.2 times. This means that the company sold the entire inventory 3.2 times. As long as we are not running out of stock, the higher ratio means that the company is more efficient in managing the inventory. So if we know that we turned our inventory over 3.2 times during the year, then we can compute how long it takes that we sell our inventory. So we divide 365 by 3.2 times inventory turnover that we computed, and we get 114 days. This means that it takes on average 114 days to sell the inventory of the company. And this may make more sense if we use the average inventory in calculating turnover. So if you want to use the average, the average inventory in this formula, you just need to find the average, the mean of this year inventory and previous year inventory, and put it in this formula. For example, if you check the balance sheet of this company that has been provided in the slides and previous videos that I showed you, the inventory as you can see, for this year is 422, but for previous year was 393. So you just compute the mean or average of these two figures, 393 plus 422 divided by 2, and then you use this figure in this formula. So it will be 1,344 divided by the average of inventory for this year and last year, and if you compute, it's 3.3 times. Actually, it depends on the purpose of the calculation. If you are interested in how long it will take to sell your current inventory, then maybe you should use the ending figure. But if for example, your focus is on the past, then maybe it's better to use the average. So it depends what you want to do, and for the industry, maybe in most cases they are reported the ending figure. So if you want to compare the company with the industry, let's say inventory turnover or days sales in inventory, then maybe you should use the ending point. So it depends on the purpose of the ratio and what you want to do, what is your concern. There is another ratio in this group, in the group of asset management ratios, and it answers this question: how fast we can collect the sales. So the formula is called receivable turnover, and the formula is sales divided by account receivable. Sales can be found in income statement, and account receivable can be found in the balance sheet. Account receivable in the balance sheet. So 2,311 divided by 188 will give you 12.3 times. This means that we collected our outstanding credit accounts and reloaned the money 12.3 times during the year. In other words, on average, we collect our credit sales in 30 days. How we got 30 days? Just 365 days divided by 12.3 times. Means every 30 days on average we can collect our uh, credit sales, right? There is another ratio. It's called payable turnover. So the formula is cost of goods sold divided by account payable. So where can you find cost of goods sold? Yes, in the income statement, cost of goods sold, and then account payable is in the current liability part of the balance sheet. So account payable is here, 344. And if you divide cost of goods sold by account payable, you get 3.9 times. And similar to the previous cases, you can divide 365 by payable turnover, and you will get 94 days. This means it takes 94 days on average to pay the bills. Actually, payable turnover and days costing payable, they measure how long it takes to pay the bills. So on average, it takes 94 days to pay your bills, right? And there is another ratio in, again, the asset management ratios, and this is measuring the generated sales for every dollar in assets, and this is called total asset turnover. And you divide sales by total assets, means for, in this case, sales, of course, you can find it in income statement. Total assets, you can find it in balance sheet. So you get 0.64 times. This means for $1 in assets, your company can generate 64 cents in sales. And now we can compute capital intensity ratio. We just divide 1 by total asset turnover, and we get 1.56. Actually, so what we did is we just flip this over, right? We flip this 0.64 over, and we get 1.56. So it takes $1.56 in assets to create $1 in sales, right? So to create $1 in sales, we need $1.56 in assets. It might seem that a high total asset turnover ratio is always a good sign for a company, but it is not necessarily true. Consider a company with old assets. The assets would be almost fully depreciated and might be very outdated. In this case, the book value of assets is very low, contributing to a higher asset turnover, right? Because we divide by total assets, and the total assets already has been depreciated. So you get high total asset turnover. Also, the high turnover might also mean that the company will need to make major capital outlays in the near future. A low asset turnover might seem bad, but it could indicate the opposite. The company could have just purchased a lot of new equipment, which implies that the book value of assets is high, right? Yeah, because the company just purchased some assets, so the book value of the assets reported in financial statements is high. So this means that the total asset turnover will be low. These new assets could be, however, more productive and more efficient in the operation of the firm. So maybe it will help the company to beat the competitors, but what you get from the financial statements and using total asset turnover is another story. So you should be very careful when you're using these ratios.